Promissory notes as currency. How you create money every day without knowing it. What if I told you every time you swipe your credit card, you're actually printing money? Not metaphorically, literally. In this episode, we break down how your signature turns into currency, how banks monetize your promises to pay, and why understanding promissory notes could completely flip your financial reality. Each time a person signs a promissory note, swipes a credit card, or digitally agrees to repayment terms, they generate what commercial law defines as a negotiable instrument, a financial security with inherent value. Under UCC Section 3 to 104, this note constitutes a legally binding, unconditional promise to pay, which meets the statutory requirements of currency in the form of legal tender substitutes. However, few people understand that this note is not just a record of debt, it is itself a form of money. When endorsed and delivered to a lender, especially without recourse, the note becomes a collateral security that can be pledged or sold to the Federal Reserve through the discount window. This transfer of ownership converts your promise to pay into actual Federal Reserve notes, which the bank receives, often before you've made a single payment. That means your signature is the origin point of money creation. The institution then turns around and charges you for something that has already been paid through your own signature. The Federal Reserve openly acknowledges this practice under 12 U.S.C. Section 412, which authorizes notes to be issued in exchange for properly endorsed securities. Furthermore, the bank records the note as a receivable and asset, but books the amount they loaned to you as a liability, since no actual money left their possession. This double-entry accounting system hides the fact that you financed yourself. Therefore, a borrower is not truly receiving a loan, but rather transforming their own financial energy into monetized credit, which banks then exploit for profit. The entire system hinges on the borrower's ignorance of the true function and power of a promissory note. Footnote: this section explains how everyday promissory notes act as the actual source of currency in the banking system, giving borrowers the false impression that they are receiving rather than creating money.